Today's episode is brought to you by Mazars. SoundCartel. Self-managed super funds, or SMSFs, are becoming more popular among Australians. Perhaps you have one yourself. Well, there are certainly many benefits for those looking to take control of where their retirement savings go. From SoundCartel, I'm Nicole Goodman, and this is Business Essentials Daily. If you do have an SMSF, or you're thinking of setting one up, beware, warns tax advisor Michael Jones of Mazars. The tax office, he says, has its sights on the industry, and it's particularly concerned about those looking to exploit the concessional tax rate. He explains the details shortly. So, how popular are self-managed super funds, really? Michael tells Chris Ashmore that according to the ATO's latest figures released in July, there were close to 600,000.
And within those funds, over 1,114,000 members. So self-managed super funds still continue to grow. It also showed just quickly that the median assets per member was 400,000 approximately, and the median assets per self-managed super fund was around 730,000. So it's going to continue to grow into the future as well.
Well, they're big numbers, but why are self-managed super funds so popular?
Well, basically, super fund in general, it's attractive because superannuation income is taxed at a concessional tax rate, to encourage people to put money away into super. Now, the investment income from a superannuation fund, just to remind everybody, it's generally taxed at the concessional rate of 15% on income, 10% on capital gains, but zero tax, right, where the assets of the fund are there supporting retirement pensions. And this low tax rate means that reinvesting income back into superannuation investments over the long term is a really powerful way to build savings. So that's why it's popular. Now, Australia's self-managed super funds are quite unique in that they give people direct control over the management of their superannuation savings. Now, many people, they don't want this responsibility, and fair enough, I say. But for a certain section of the community, this autonomy over their superannuation is very important. And these people are motivated to be personally engaged in building their savings. Now, direct control, in many areas, it's a double-edged sword, because the direct control members have over their assets leads also to a wide range of rules to protect the integrity of the superannuation system. So what we're trying to touch on today are just the key rules for when self-managed super funds transact with related parties on a non-arm's length basis.
Well, what are the tax consequences when self-managed super funds don't transact at arm's length, Michael?
Well, those amounts are regarded as non-arm's length income, and they're taxed at 45%. So it's quite a slog. You think the low tax environment will put you there, step over the line, and you're whacked with 45% tax. Now, this non-arm's length income, people call them gnarly, just for convenience, and gnarly sounds appropriately nasty. Well, this higher rate of tax, it's obviously there to deter taxpayers from channeling income and doing things that will boost the value of their funds and take advantage of the concessionally taxed rate environment in the super funds, rather than having the income in company or individual tax rates.
So what's the tax office doing?
Well, look, the ATO, they support the concept of self-managed super funds. I'm confident they do. But they're also very keen to regulate the system. And in recent years, the ATO have highlighted a number of areas of concern where people are attempting to exploit the concessional rate of tax of super funds. And so these gnarly provisions have been applied and also expanded so that they include a focus on funds expenses. So not only non-arm's length income in a fund, but non-arm's length expenditure in a fund. There's a real tension between creating a savings systems which empower people to manage their own savings, making them motivated, and engaged, but that tension's against creating rules that dampen down that engagement to ensure the system works properly. And these rules have been argued about for many years, culminating recently in some tax office publications that attempt to settle the whole area.
Do you have any examples of gnarly?
So there's really 4 types of gnarly. We have dividends from private companies that are not at arm's length. We have income from transactions with parties that are not dealing at arm's length. We have income from trusts where the super fund doesn't have a fixed entitlement to the income of the trust. Or, fourthly, we have income from trust where the fund does have a fixed entitlement to the income of the trust, but the parties are not dealing at arm's length. So in these circumstances, instead of paying 15% tax or nil tax, the fund will be paying 45% tax on things like, the private company dividends and the associated franking credits and any capital gains on the disposal of those shares. It'll also be paying 45% tax on any rental income from a property in those circumstances, and any capital gain on the disposal of that property will attract 45% tax. And in those third and fourth examples, unit trust distributions and capital gains on disposal of those units will be taxed at 45% tax.
45%, goodness gracious, that would spoil the enthusiasm for super. What triggers the gnarly tax?
Well, really, gnarly is designed to capture transactions where you've got a super fund and another party that are not dealing at arm's length, and as a consequence, the fund's share of income from whatever the transaction is more than it would have been if they were dealing at arm's length.
And how does a trustee of a super fund know that the fund is dealing at arm's length?
Well, in nearly every case, it's about transactions with related parties. So if the parties are related, the general inference is that they're not dealing at arm's length, unless it can be established that they are dealing at arm's length. And this usually means like obtaining third-party evidence that the terms of the transaction are the same as one would expect if the fund had been dealing with a stranger.
Any examples, Michael, of common transactions that could trigger gnarly?
Yep, like we said, like investing in private companies, common, leasing assets to related parties, loans to related parties or loans from related parties, or even when the fund engages with related parties to provide certain services.
And can anything be done to reduce the risk of a transaction triggering gnarly?
Well, the thing to be done is that everything should be at arm's length, and you must be able to demonstrate that it's arm's length, and that sometimes can be difficult.
Well, Michael, you mentioned earlier these rules also cover non-arm's length expenditure. Can you explain about that?
When a fund has non-arm's length expenditure, the income connected to that non-arm's length expenditure will be taxed at 45%. So, for example, if a self-managed super fund bought an asset for less than market value from a related party, then the income from the asset and any capital gain from the disposal of that asset would attract the gnarly provisions. And this is where it gets crazy, like the application of these rules, it can really be quite outrageous sometimes. Take an example. If, say, a fund incurs expenditure and that expenditure is, say, accounting fees, and those accounting fees don't relate to any particular asset in the fund, and those accounting fees were done at less than market rate, so they weren't at arm's length. Because the accounting fees relate to basically all the income of the fund, then all the income of the fund is taxed at 45% under gnarly. I mean, that's a disaster. And what a disproportionate consequence to not charging market rate on accounting fees. So, watch out. I mean, don't despair, but just have your eyes open and manage your fund properly.
Well, before we go, Michael, what should trustees of self-managed super funds do?
If you have a self-managed super fund that has dealings with related parties, and the classic example is, renting a commercial property to a related business entity, then you should get professional advice to ensure that you've taken appropriate action to satisfy yourself as a trustee that the transaction is at arm's length, because this is a hot topic for the ATO.
That was Mazars partner and tax expert Michael Jones. This episode of Business Essentials Daily is produced by the team at SoundCartel. Thanks for listening. I'm Nicole Goodman. We'll bring you more Be Daily tomorrow. Follow at BE Daily Podcast across social media and head to bedaily.com.au for more from the Business Essentials Daily podcast. SoundCartel. This episode was brought to you by Mazars. To find out more, visit mazars.com.au. That's mazars.com.au.